Ever wondered what reinsurance or aggregate limit means in insurance terms? It's no secret that insurance language can feel like a tongue twister of jargon, but fear not. Today we're going to unravel some of these complex terms, from reinsurance and aggregate limit to umbrella insurance and captive insurance company, and even the intriguing excess and surplus lines insurance. We'll also touch on indemnity and what it means in the insurance world. Ready to delve into the world of insurance jargon? Let's get started. First up, let's unravel the concept of reinsurance. Reinsurance, in its simplest form, is insurance for insurance companies. It's a process where an insurance company, also known as a primary insurer, transfers a portion of its risk to another company, known as a reinsurer. This helps the primary insurer manage their exposure to large losses, ensuring they have the financial stability to handle claims, even in the event of major disasters. Next, let's dive into the term aggregate limit. This terminology refers to the maximum amount an insurance policy will pay out over a specific period, often a policy term. This limit can apply to various claims under the policy, and once it's reached, the insurer won't cover additional losses. Aggregate limits help insurance companies manage their risk and ensure they can fulfill their obligations to all policyholders. So, that's reinsurance and aggregate limit for you. Clear as mud? Next on our list are umbrella insurance and captive insurance company. Let's dive right in. Umbrella insurance, as its name suggests, is like a big umbrella that provides additional coverage. It's a type of liability insurance that goes above and beyond the limits of your primary policies, such as car or home insurance. So, when the rain of liability claims pours down, an umbrella insurance can save you from getting soaked. Now, let's turn our attention to something called a captive insurance company. This is an insurer that's created and wholly owned by a single organization to cover its own risks. In essence, it's a form of self-insurance. So instead of paying premiums to an external insurer, the organization pays them to its own captive insurer, keeping the money within its own corporate family. That's the scoop on umbrella insurance and captive insurance companies. On to the next. Now let's decode excess and AMP, surplus lines insurance and indemnity. Excess and AMP, surplus lines insurance, often referred to as E&S, is insurance coverage for risks that are typically difficult to insure through standard insurance markets. These might include risks that are unique, high risk, or unpredictable. Think of it as the special forces of insurance, stepping in when standard insurance says no. Now, on to indemnity. This is a fundamental principle of insurance. It's all about making you whole again after a loss. Basically, if you suffer a financial loss due to an insured event, your insurance company will compensate you, returning you to the financial position you were in prior to the loss. It's like a safety net, ensuring that you don't fall into financial hardship due to unforeseen events. And there you have it, excess and AMP, surplus lines insurance, and indemnity made simple. Let's wrap things up, shall we? We've covered a lot of ground today, exploring some advanced insurance terminologies. Just to recap, we began with reinsurance, the practice where insurance companies transfer a portion of their risk to another insurer, thus managing their exposure to large losses. Next, we discussed the aggregate limit, which is essentially the maximum amount an insurance policy will pay out over a specific period. We then moved on to umbrella insurance, a type of liability insurance that provides additional coverage beyond the limits of primary policies. Captive insurance company was our next stop, an insurer created and owned by a single organization to cover its own risks. Excess and surplus lines insurance followed, offering coverage for risks that standard insurance markets find challenging to insure. Finally, we delved into the principle of indemnity, the promise that insurance is designed to compensate the policyholder for their loss, returning them to their original financial position. These terminologies, complex as they might be, form the bedrock of the insurance industry. Understanding them will not only enhance your grasp of how insurance works, but also empower you to make more informed decisions. And that's a wrap. Stay tuned for more insights into the complex world of insurance. Until next time.